Hello and welcome to Accounting 2208 Tutorial 18.1. This tutorial will focus on leases and specifically on the additional lease example where we have Toronto company leasing equipment from Vancouver company. And so here's our situation. We have Toronto, who is the lessor, leasing a building to Vancouver, who is the lessee, for a 5-year payment lease term period. So that's going to be the payment in our calculation. Sorry, not the payment, the number of periods. The payment is determined by the lessor is $113,952 with payments at the beginning of the year, which means we'll need to use the begin function. The building has a cost of $500,000, which is the PV in our calculation, but that is used by the lessor to calculate the lease rate, or sorry, to calculate the payment. There's also a $400,000 residual, which would represent the future value. It's unguaranteed. And finally, the incremental borrowing rate is 11%. So that's the discount rate. That's the IY we're going to use. And the, the incremental borrowing rate is 11% for Vancouver, and the implicit rate of interest for the lessor is 10%, and we have to use the lower of those two. We're told that Vancouver, the lessee, does not know the lessor's rate, so we don't have a choice but to go with the incremental borrowing rate of 11%. And so the next slide will review the calculation of the present value of the minimum lease payments. Okay, so we always typically look first from the perspective of the lessee. So the lessee takes the payment from the lessor and determines what the present value of those minimum lease payments are. And the minimum lease payments will include any lease payments plus any guaranteed residual. Okay. Plus a guaranteed residual. It's very important to look at a problem to determine whether or not that residual is guaranteed. If it's not guaranteed, the lessee omits it. Now, whether or not it's guaranteed does not matter to the lessor. The lessor will always use a residual, guaranteed or not, in the calculation of the payment, and we'll look at that later on. So in your calculator, you would put 5N for the number of periods in the lease term. We're going to use 11I because we have to use the lower of two rates. One, the implicit rate of the lessor, okay, and two, the incremental borrowing rate of the lessee, which is Vancouver in this case. But we don't know what the rate, the implicit rate that Toronto has put into the lease. So if we don't know that, we can't use it, and so now we have to use 11%. The payment is always given to us by the lessor. Now, there may be a situation where you may have to calculate the payment from the lessor's perspective. And because our residual is unguaranteed, there is no residual, so the future value is 0. Unguaranteed, if I could spell, guaranteed. And then if you compute PV, so comp PV, again, making sure your calculator is in begin mode, you should get 467,482. If you do not get this, don't proceed. You have to make sure that you come up with the correct present value. If you have a problem with this, then please contact your instructor. So the first part of the question, after having you calculate what the present value of the lease payments is put together a lease amortization schedule. So we start with the balance of the lease, and then we have payments each year, calculating the principal and interest. The first thing to notice, though, is that in a lease, and this only happens with leases because we are using the begin mode and because we make our payments at the beginning of the period. This is different from bonds and notes payable where we were making payments at the end of periods. So it's important to remember that the very first lease payment that's made up front is 100% principal, 100% principal reduction. Okay, so there is no interest, and so all of it reduces the balance of the lease obligation, and then successively every period after that we calculate our interest expense, of course, as being the balance in the lease times the interest rate. So here our balance 353,530 times 11% gives us our 38,888. 38,888, and that continues each time. So 278,466 will give us this interest, etc. And of course, the principal reduction is the difference, right, between the lease payment, so lease payment minus the interest equals principal reduction, okay, every single time. The other important thing to note is if you prepared a lease amortization schedule for both the lessee and the lessor, they will be different because the lessee is not using the implicit rate. And if you were to look at this visually, you have a lease starting on January 1st that has no interest because all of that payment is principal, and then we have our year end, and then which we will have to do an accrual for the interest, and that's what's happening here. Is this interest actually is for all of 2014. That's a typo here, 2014, and that'll be the interest accrual, and that interest is actually paid on January 1st, 2015. Okay, so even though that the interest is part of this payment, it actually pertains to the year ended December 31st, 2014. Okay, and now we proceed with part 2, which is to prepare all our journal entries for Vancouver from January 1st, 2014 to the first payment of 15. So when we enter into the lease, we're going to debit our leased building because this is a finance lease. And then we're going to credit the obligation under the capital lease for the present value of the lease payments, $467,482. Then immediately, also on the same day, we're going to record our payment. This is our initial lease payment. And so right away, there's a credit to cash and a debit to the lease obligation. Alternatively, this could be done in one journal entry where you have a credit to cash for $113,952, and then a debit to the leased building. So the leased building for $467,482, and the difference to the lease obligation of $353,530, roughly $530. Okay, so this is a single journal entry. This is preferred though, because what it does is it shows a full audit trail. Okay, so it's preferred that you break it up and to do it into two separate pieces, but this is also acceptable. Then at the year end, here's where we have our interest accrual, right? So our accrued interest expense. Where we have our 38,888, and that was the balance of the lease, which was 467,482, right? Actually, take this one, 467,482 minus 113,952 gives us 353,530. We multiply that by 11%, and that's our interest accrual. So we're debit our interest expense and credit our interest payable, not the lease obligation, not lease obligation. This is interest, this is separate obligation. Then also at the end of the first year, not only do we have interest expense, but we have amortization expense. Now, so we have to take our, to calculate our amortization, you may remember straight line amortization is cost minus residual over life. Okay, so our cost is $467,482, which is the present value of the lease obligation. $467,482. There is no residual, right? Because the residual is unguaranteed and we're not paying it, the residual is 0, and we divide that by 5 years, which is the lease term. Okay. Now, not all questions use the lease term. In this example, there isn't a bargain purchase option. Okay, and so therefore it is assumed that the title reverts back to the lessor, So therefore, it is not anticipated that Vancouver will take the asset at the end of the lease. So if the asset does not stay with the lessee, then it goes back to the lessor. And so therefore, the amortization or depreciation period is only the lease term. If this was a lease where there was a bargain purchase option or something to the effect that indicated that the lessee would take title of the asset after the lease term, then we would use the useful life of the asset. But that is not the case here. So we have to use the lease term because the title reverts back to the lessor. Okay, and there's a little piece of this calculation here that's 12 over 12. That's because it's a full year. Sometimes you can get into leases partway through the year. So it's very important that you remember how to prorate. I'm not going to go through and change this, but if the lease was entered into on July 1st, well, that would be 6 over 12. Okay. And then the lease payment on January 1st, this is the actual payment. We're going to credit the interest payable for the $38,888 that was accrued the day before. We know our cash payment is $113,952, and the lease obligation is the difference between those two, or this is the principal reduction. Okay. You can tell from these journal entries here that it's not necessary to prepare an amortization schedule, right? These numbers, you can go back to the amortization schedule and see the 75,064 and the interest, but it's not necessary. So unless you're asked to prepare an amortization schedule, you could probably save yourself a lot of time and don't bother, but make sure that you understand the calculation of the interest expense as being the balance in the lease obligation account, lease obligation that had $467,482 less the principal payment of $113,952, giving you a balance of $353,530. So it is suggested that you maintain a T account for the lease obligation, but you don't need to do an amortization schedule. Then the third requirement is to show what this would look like on the balance sheet for the lessee. So the lessee has two sides to the balance sheet to worry about. It has the asset side where it has the leased building less the accumulated amortization calculated at $93,496 from the previous slide. So the net carrying value on the balance sheet for the lessee is $373,986. Then there are liabilities. So there is an interest payable of $38,888, and then the principal portion of the lease obligation. So basically, the current portion is always going to be the next payment. So if the payment is $113,952, we need to show, okay, well, how much of that payment is split between the principal and the interest? Okay, and then, and this is something that students always forget, they forget a couple of things. They forget either the interest or they forget to break out the lease obligation into the current and long-term portion. So what we have at the end, lease obligation, is a balance of $353,530, and we have to know how much of that is current and how much of that's long-term. So the current portion is the principal reduction in the next payment, so $75,064, which means that the rest has to be $278,1 466. So this is very simple. Students tend to overcomplicate it, but that's what we have. So the sum of the current obligation here, 75,064, plus the 278,466 must equal the balance in the lease account at the end of December, okay, which includes the initial PV of the lease minus the first payment. All of that went to principal, leaving us with the 353 balance. Okay, so now we look at requirement 4 and see how all of this changes if the residual was guaranteed by the lessee. So this is a different situation, and we're saying that the implicit rate is known. Okay, so because the implicit rate's known and the residual value is guaranteed, then we calculate the PV of the lease payments. Okay, we do that differently and say, okay, we know that I have a 5-year lease, but now my IY is 10 because I know the lessor's rate. However, just because I know the lessor's rate does not mean I use it, because I have to take the lesser of the two. So if this was 12%, then I would have to go with the 11%. But because 10 is less than 11, and I know the rate, so now this is known, I use the 10%. The payment again is provided by the lessor, but now I'm including a future value, which is the guaranteed residual. So now this is a guaranteed residual. Okay, and guess what? If you calculate the present value, you end up with $500,000. So we can go through and create a new amortization schedule, this time with 500,000 as the beginning balance. Again, all of the first payment is principal reduction, leaving us with a balance of 386,049, and we would then calculate successively the interest each period by multiplying that balance times now 10%, right? Times 10% every time. Okay. Then back to our journal entries. So once we get into the lease on January 1st, again, debit the lease building, credit the obligation, this time for 500,000. On an exam, you could use 500,000 rather than 500,001. This is a rounding error. Technically, they should, well, don't worry about the technically, because the data says that the PV of the building is 500,001, then we would record it at that. One thing to remember is that it is possible for the PV of the minimum lease payments to actually be greater than the present value or the cost of the building. And if that's the case, if the PV of the minimum lease payments is greater than the cost, then we have to go with the cost. So for example, if the PV of the lease payments ended up being, let's say, $510,000, that's greater than the 500,001. We must use 500,001. We cannot use an amount higher. Okay. In the previous example, the present value of the minimum lease payments were less than 500,001, and go back and look, we used the lower number. Okay. So basically, when recording the lease obligation, it can never exceed the actual cost of the asset. Okay. The second journal entry here is the same as the first one. We debit the lease obligation and credit cash for the amount of the payment, so there's no change there. Because we're using a different interest rate and our balances have changed, we're going to have to recalculate the interest expense. And so the balance in the T account, right, after taking 500,001 minus 113,952 gives us 386,049, and that times 10% is 38,605. Again, this is rounded 386,049. 10% of that is 38,649, so 605, and that becomes our interest payable. Our amortization expense calculated now, we have to adjust this. Our cost minus residual, right, over life, is 500,001 minus the residual, because now we included a guaranteed residual in the calculation, divided by 5 years times a full 12 over 12. Okay, so it's prorated 100% over the 12 months. So amortization expense 92,000. And then our final journal entry to record the cash payment on January 1st, 2015. Again, 113,952. The interest payable, 38,605, carries from the previous entry, and then you can plug this lease obligation amount, 75,347. Okay, and so now we move over to Toronto, who is the lessor. And our first requirement is to do an amortization schedule to see what it looks like from the lessor's perspective. And so we would calculate the PV of the lease payments in the same way, but now using all of the lessor data. So it's a 5-year lease. The lessor knows the rate that they're using in calculating the payment, 10%. The residual, and this is whether it's guaranteed or not. Guaranteed or unguaranteed, it doesn't matter. Right? We still include the residual as a future value in the calculation. Now, if we work backwards and say take a payment of 113,952, a future value of 40, 5N, 10 IY, we get 500,001. But guess what? It's the lessor is actually the one that determines the payment. And so how does the lessor determine the payment? The lessor would have done this: 5N, 10 IY, negative 500,001 for the PV, 0 payment, 40,000 future value, and then it would compute the payment, and the calculator would kick out a payment of 113,952. This is how the lessor actually calculates the payment. So all we're doing here is working backwards from the payment that the lessor would have calculated, and we prove that the cost or the PV of the building is 500,001. Okay, so this question could have been worded slightly different to say, actually, to leave out the payment piece. The cost of the building is given. We know the residual. We know the lessor's rate. And so it could have been a requirement of this question that the very first requirement is calculate the payment to be determined by the lessor. And that's how you do it. And now we do the lessor journal entries for the same period of time. So the lessor is going to, now you have to be very careful with these, is going to debit the lease payments receivable for all of the conceivable payments. Okay, even though the residual is unguaranteed. It doesn't matter from the lessor's perspective if the lease is guaranteed or unguaranteed. Okay, so the lessor will always determine, okay, I've got 5 payments of 113,952 plus a residual, 609,760. The building for lease, I'm going to credit, because what would have happened is the original entry would have been, let's say that the lessor goes out and buys the building from somebody else and then turns over and lease it. So they would have debited the building for lease. I have a nice writing, building for lease of 500,001, and then they would have credited their cash to buy the building, right? And then now they are leasing this building out to the lessee, and of course that building comes off their books basically. So credit the building for lease. If this was an asset like a car, you know, if you have a lessor that, let's say, is in the business of leasing cars, then those cars would actually technically kind of go into inventories. So they would debit the inventory when they purchase the car and then turn over and credit the inventory of cars, or they could use a capital account. It really doesn't matter. But then the difference between the lease payment receivable and the amount for the The building is 109,759, and that is the interest, the unearned interest income. Okay, this is also a finance lease, as opposed to a sales type lease, because there is no cost of goods. A sales type lease happens when you have a lessor that, let's say, actually manufactures the equipment or the asset and then uses the lease as an incentive to turn over and sell it. So companies like Bombardier or anybody that makes airplanes or something may also lease the asset, and so they make money both off the profit margin built into the plane plus some profit off of the lease. But in this case, the company that's leasing, they don't build buildings, they just buy the building and turn over and lease it. So their only source of revenue is interest, and so that's why this is a finance lease. Then we have a simple journal entry that mimics what we saw on the lessor side, on the lessee side, where the lessee pays cash and is received by the lessor, and all of that initial payment goes to reduce the principal. Then where the lessee at the end of December 31st calculates a interest payable amount, the lessor calculates how much of its unearned interest income it can earn, right? Because it has to turn that into earned income. So it'll do the same thing. It'll take the 386,049 times 10%, right, which is the balance, giving us 38,605, and that is how much that can be earned as revenue in the period. Again, watch the prorating. And then there's a typo here in the solution. That should be January 1st, 2015. Guess what? The cash payment is received and the lease payment receivable is credited. Notice, however, here that there is no amortization. The lessor does not amortize the asset, period. Okay, only in an operating lease does the lessor calculate amortization or depreciation on the equipment. In finance leases or capital leases, it is the lessee that calculates the amortization. I can't tell you how many students make mistakes and calculate depreciation or amortization for the lessor. Not the case. And our last requirement here is to show what this looks like on the balance sheet for the lessor. So what the lessor has is an investment in the lease, which could also be called lease receivable. That's not uncommon. Its investment in the lease is basically the principal portion, and let me go back. The lessor also separates this into current and non-current elements, right? So the current amount, the investment in the lease, is actually always going to be the amount of the payment. Guess what? This was the same thing as the lessee's current portion of the lease obligation being the payment. And so that consists of the principal reduction on the next payment plus the interest, right? And so if we trace back all these journal entries, here we see that the lease payment receivable was set up at 609,760 with an initial payment going all against the principal. Then the balance in the lease receivable was 495,808. We take the difference between the 495,808 and the amount of the unearned interest, and that gives us our net investment in the lease. And so so at any time, our net investment in the lease is the balance in the lease receivable account minus the balance of unearned revenue. So that's where this comes from. 495,808 minus 109,795 is 386,049. But then we add to that the interest, the unearned interest revenue that is to be earned. So that's how we end up with 424,654. And see how this interest income that is now earned becomes part of the current portion. So basically, the investment in the lease by the lessor at any point in time is the non-current portion of the payment plus, we can actually prove this amount here of 310,702 as being the difference between the lease receivable and the unearned interest income of 386,049 less the current portion or the principal in the next payment, 75,347. And there's our 424,654. So this concludes tutorial 18.1 that covers a finance lease for Vancouver and Toronto.